Hello and welcome all to Beat the Street. Today with me, I have Mr. Akshay Parmar of Unihealth Hospital. He is the managing director and promoter of Unihealth Hospitals. The hospital sector has been growing for the last few years, and following the constitution of the Nifty Hospital Index in the 2020, it's experiencing a new euphoria. Hi, sir.
Hi,
How
how
are
are
you?
you? Good, thank you.
Fine. Good. So, so why don't you just give a brief about the company?
Sure. So, Unihealth Hospitals Limited was incorporated back in 2010. The two founders, that is Dr. Anurag Shah and myself, we both graduated from KJ Somaya Hospital in Bombay, in Mumbai, completed our MBBS. And this project was taken up. I mean, the incorporation of the company, this entire business idea took shape somewhere during our internship. That is how Unihealth took shape in 2010. The first vertical for the company was basically streamlining the entire medical value travel business, which was basically aimed at patients from all over the globe coming into India for the required treatment. And that is how UniHealth started with the aim to streamline this process. Between 2010 and 2015, medical value travel or medical tourism, as it is more commonly known as, was the major vertical for the company. In 2015, we decided to start making investments and setting up our own medical centers and hospitals in Africa, which is where we had found a stronghold during our medical travel business. That is what led to the creation of the first UniHealth Medical Center and gave birth to the UMC brand. And between 2015 and 2018, we expanded our footprint from Tanzania into Uganda and Nigeria and set up a network of medical centers and hospitals. In 2019, the company decided to create another business vertical and for providing consultancy services to other hospital projects, both in India and Africa. As we speak today, under that vertical, we are providing our services to more than 1,300 beds on a consolidated basis across multiple projects in India and Africa. Then came in 2020, which was the COVID year, when a lot of businesses underwent a lot of disruption. And this is where the fourth vertical of the company, which was pharmaceutical and consumable, medical consumable export and distribution, took shape. It was during the COVID period that we explored and we hinged onto our strength of having a set logistic chain, supply chain management between India and select African countries. And we decided to venture into this as a standalone business unit where we were exporting and distributing medical consumable products and pharmaceutical products. Today, we represent multiple Indian manufacturers across these two segments and distributing their products in Africa. So, on a consolidated basis, if I look at the business verticals for the company, we ventured out from medical travel into our own medical centers and hospitals, moving ahead onto the consultancy services segment and the export and distribution of pharma and medical consumable products. All the verticals for UniHealth have been interlinked and somewhere or the other have derived strength or given strength to the other vertical. In 2023, we decided to go public. That is when the company got listed on NSE Emerge. And since then, the last 2 years, we've expanded our footprint by adding India as a major strategic initiative, where we have recently commissioned our first facility, which is in Navi, Mumbai, and are soon, going forward with the second facility in Nasik. The idea now, in terms of expansion, is to create 1,000 bed capacity over the next 2.5, 3 years, of which 500 to 600 beds would be centered around India, and 400 to 500 beds would be centered around East Africa, where we are consolidating our position in the countries where we already have a presence, and then sequentially we'll look at expanding into newer geographies.
Great, sir. Great. That was a good introduction to the company. So it was a, I can understand it was a dream project between two friends in the college.
That's right. So this idea took shape sometime around our last year of MBBS, and when we entered internship, the thought process was very simple. Whether we take forward this idea, experiment, give it some time to see how it fructifies, or we go down the standard path of pursuing post graduation in the same field, maybe become surgeons or become consultants. So that is where we decided that why not give this idea a chance? We should not regret it later in life. And that is how in 2009, 2010, we started working towards giving shape to UniHealth as a company, as an entity, and take it forward from there on. As I can say that, perhaps we were at the right time at the right place, and things aligned very well for us, such that we decided not to look back and go back into clinical practice ever.
Definitely, sir. Sir, you have rightly mentioned. I'll just share the presentation and I'll ask you further questions from there.
Sure.
So first of all, what was the reason for expanding into the African continent in the first place? In
Right.
we expanded in African markets in 2015.
Right.
Yeah.
So, like I mentioned, we started in 2010 with medical tourism being the key focus for the company, or the major vertical for the company. Now, medical tourism is basically where patients are traveling from outside India, coming into multiple hospital facilities across the country for the required treatment. Now, there are majorly two reasons why for which patients usually travel out, leaving their country. One is cost efficacy, and second is lack of available resources. So the biggest market for India in terms of medical tourism has been Middle East and Africa. So it's been countries where either the cost is significantly high, or the services are not available. Now, if I look at Africa, mainly Sub-Saharan Africa, Sub-Saharan Africa did not have the right resources back then. Even today, it's still way behind in the curve, and that is where majority of the patients were traveling from into India for the required treatment. So naturally, to expand our presence in the medical value travel industry, we started venturing out into the African continent, and that is where we found a good stronghold. We found a good supply demand gap. We formed good partnerships out there locally, and that is what gave us the realization that perhaps making the first move out there would be more fruitful for a small and medium enterprise like ours, as compared to trying to venture out with a hospital facility or a medical center in a market like India, which is quite competitive, where the supply demand gap is not exactly the same way the way it is in Africa, where margins are pressurized in some way or the other. So, with limited resources and limited capital, we thought it is best allocated in a country or in a geography which is upcoming, which has a high supply demand gap, and where, as UniHealth and as the founders, we have created our own niche and stronghold. That is what took us to Africa in 2015-16, when we decided to invest and put up our first medical center.
Got it, sir. So, sir, are there any upcoming trends in the African market also? And so we are currently present in mainly three countries, right? Uganda, Nigeria, and Tanzania. So,
That's right.
are there any strategy to go into other countries in African continent? And what is the difference between these three countries, or are they similar
Right.
at part to one another?
Yeah. So the first part of your question, the emerging trends for in Africa. So yes, over the last 10 years, if you have to look at it, Africa has been, the emerging continent in a way or the other. There's a lot of focus in multiple sectors in that continent. There's something new happening almost every second month out there. The opportunity is great. Definitely, the entry barrier is also high. There are multiple challenges on ground for a new entrant. But if you have found the right mix in terms of the location, the country, the geopolitical stability for the said country, and you have feet on the ground, it is still a fantastic place to be in for venturing out and tapping into the opportunity that that continent has to offer. The major difference between the countries where we are present is that two of these, Uganda and Tanzania and East Africa, whereas Nigeria is in West Africa. So East Africa, from a currency perspective, from a geopolitical perspective, is way more stable compared to the West African part, where Nigeria is located. So in Nigeria, there have been challenges related to currency depreciation. So in fact, in April this year, with the start of this financial year, we have exited the project in Nigeria. So now we've got physical presence in terms of our medical centers and hospitals only in Tanzania and Uganda. The hospital in Kano we handed over, to in April 2025. Precisely, there were two major reasons why we did that. One was over the last 24 months, the Nigerian currency has been significantly depreciated against the dollar. So where it was once about say about 350 to 400 naira to a dollar, today it is somewhere between 1500 to 1700 naira to a dollar, and this has happened in a short period of just about 24 months. So one impact that it had, despite our revenues in the local currency growing, despite us being profitable locally, when we were converting that into the pure INR terms on consolidation, the impact in terms of growth was negative. So going forward, it was limiting our ability to invest more into that continent, into that country, and expand. So and there's a if you're unable to expand, then there's no point of being present in that country for a very long period. That is one reason why we exited Nigeria. The second reason was more of an ethical one, where Nigeria has been witnessing a lot of challenge with electricity, such that the geography where we were present, Kano, we were running on diesel for almost 20 hours in a day for almost the entire year. Now, in such a scenario, a lot of government and private hospitals out there shut down critical services. So they were running only their basic services because they wanted to cut down on the use of fuel for generators. Now, for us, it became an ethical issue because we had one of the larger private sector ICU units. We had the entire equipment. So, if there was a patient who needed intensive care, just because we wanted to save on the cost of fuel and not run our diesel generators, if we were not to put them on the ventilator or provide them the critical care services, it would be incorrect and unethical for us. So we kept running it, till we were operating that facility. But we also realized that it may not be feasible going forward to continue services in this manner. There were challenges, with the downtime of the generator. How do you manage patients in the critical service then? So that is where we realized that it is better that we take a step back, and we got the right opportunity to hand it over to the property owner. So unlike in Uganda, in Nigeria, we do not own the premises. In Uganda, we do own the land and building. Since we were not owners of the premises, it was easier for us to exit. Luckily for us, the property owner stepped forward and they offered to take it up and operate the facility on their own. That is where we found a good exit and we made a move back. So today, Nigeria for us still remains critical as a country, where we will be looking at medical tourism as a big segment to bring in patients from that country, utilizing our entire network to UMC facilities that are being set up in India, in Mumbai, in Nasik. We will also be having our teams of doctors travel from India to Nigeria to operate at our partner facilities. So eventually, we have moved on from operating a hospital to operating, specific
Consultancy.
services out there, which will ensure that the group, though having a lower revenue from that country, is going to have a decent profit margin out there. So that is how we are looking at when it comes to Nigeria. In comparison, East Africa is way more stable when it comes to currency. It is way more stable when it comes to the geopolitical scenario. The government to government liaising and relationship on a diplomatic level between India and these countries in East Africa are also extremely strong. So, and lastly, the connectivity between India and these countries, whether it is Uganda, whether it's Tanzania, whether it's Kenya or Ethiopia, they are very well connected with Mumbai. So you've got direct flight connections between all these countries and Mumbai. It's a direct flight of about 5.5 to 6 hours. That allows the management team, our doctors, to frequently travel without too much of an hassle. So, from all those perspectives, we thought it best that we consolidate our position in East Africa. We grow, and expand our presence in this geography as we simultaneously expand our presence in the state of Maharashtra to begin with respect to our Indian operations. So that is how we've been focusing and consolidating our positions in East Africa, and that is where the next phase of growth for the company will also be.
Understood, sir. So that's the beauty of the hospital business. You can do like अच्छा भी करना होता था and you can also make money out of it. That's the
Yes.
beauty of the business. Sir, as I know, sir, like the other founder, Dr. Anurag Shah, like also sits in the Uganda hospital. So he has a foot on the ground in the African region.
Yes, so in 2017 November, he decided to make a move. He changed his base from Mumbai to Kampala, that's in Uganda, because at that point of time we had significant investments that were already made in Uganda. That has been our flagship hospital till now. So it was critically important for one of us to be on ground so that we were able to better manage the facility and also look at the potential to expand further in that geography. That is when he made that decision and he relocated from Mumbai to Uganda. Going forward, he is going to be looking into the expansion that the company plans to have in East Africa, and
Yes.
I will be focusing on the expansion that we intend to have in India.
Got it, sir. Got it. So when we started the Indian unit, so was it a pivot to the African market, or it will be like an supplementary thing to the African market? Like as you mentioned, like we will use the Indian operations to bring more medical tourism that we used to do earlier also, but with our partner hospitals. Now we will do
Right.
it with our own medical facility. So what
So
was
to
your
be
thought
true,
process
to
in
be
like,
true,
yeah, go ahead, sir.
I will de-link this. There is no real reason when I look to align Indian operations with African operations. So medical tourism, as I always call, it's the cream and the cherry on the cake. The idea to invest into India is primarily because as a market, India is extremely bullish. It is growing at a very rapid pace, specifically when it comes to healthcare services. The potential is still, massive for each player to expand. If you look at the larger players, whether it's Apollo, Max, Medanta, Fortis, or all of these put together, they have lined up thousands of crores worth of investment in the coming 5 to 7 years. So, as an individual and independent market, India itself is extremely exciting. For us at UMC, what happens is that India gives us the opportunity to scale, while Africa is a mature business for us where the margins are significantly high. So we are able to consolidate and get the best of both these geographies. Where going forward, India is a potential geography where we can look at scaling up from 500 to 5,000 beds in a significantly shorter span. This is not the kind of scalability that Africa might offer. Africa as a continent is spread across 54 countries. Now, there are multiple countries where the population is just about, say, a few million people. It's less than, 3 or 4 Indian cities put together. So the scalability in these countries is limited in that manner because of the sheer numbers. Whereas in India, you've got that potential to scale up massively. So it's a combination. It's a strategic initiative that we've taken where we will be growing rapidly in India. We will be banking upon the opportunity which is native to this country, and simultaneously, because of our presence in Africa, we will be enjoying the benefit and the fruits of profitability of transferring patients from UMC in Africa to UMC across India. So that is something that is going to perhaps allow us to improvise our margins, allow us to break even earlier, and allow us to position UMC as a truly multinational healthcare services brand.
Understood, sir. So agreed. So I agree. Like the structural tailwinds in the Indian market for the hospital sector are huge. I would say huge. The insurance penetration is increasing. The people are willing to go to hospitals and spend a bit on their health.
Yes, patient
And
education in India is way ahead as compared to patient education in Africa. Thanks to COVID, Africa was able to catch up way earlier. But otherwise, like you rightly mentioned, the insurance penetration and the intent to actually go out and get healthcare services is there at a much deeper level in India today, thanks to the large variety of government schemes, whether it's at the state level or at the national level, and the amount of public campaign that happens across with respect to sanitation, with respect to vaccination, with respect to overall healthcare services, the preventive healthcare. That has allowed the penetration of healthcare services to tier three and beyond also. But what it has done is it has educated the Indian population to an extent where now they are aware and they are forthcoming when it comes to taking right steps across diagnostic services, getting diagnosed and eventually seeking treatment, which has allowed the market to expand massively all across, whether it's tier one, tier two, or tier three and beyond. At each level in the Indian context, you've got opportunities which are unfolding almost every single day.
agreed, sir. Totally agreed. Sir, are like any other country in the African continent that we are planning to enter into?
So for now, for the next 12 to 24 months, the focus will be on consolidating our presence in Uganda and in Tanzania. We are looking at adding a secondary care 20-bed facility in Tanzania later this year. We are, in the last leg of discussions to add on maybe a 100-bed capacity tertiary care hospital in Dar es Salaam, which is the commercial capital of Tanzania. So the focus for the next 12 to 24 months would be to consolidate our position and expand the network of services in these two countries, maybe add super specialties in these two countries. Simultaneously, we do keep on exploring opportunities which are coming up in countries like Kenya, Ethiopia, and at the right time, when the right opportunity comes across, we will be open to expanding our footprint in a couple of these countries also. But yes, we would want to limit our expansion at least for the next 3 years to say a consolidated number of 3 to 4 geographies in Africa, reach the prime position in these countries, be amongst the top private players out there, and then look beyond these countries that we have a presence in.
Okay, got it, sir. So also like does the African markets provide any better ARPOB or the revenue per patient? Does it provide a better ARPOB than India, or is it least, or is it at the same line or something?
So the ARPOB when it comes to Africa is comparable to a similar bed capacity or a bed strength in India. So all of our African
Hmm.
facilities, or as UMC, our focus has always been between 50 to 200 bed capacity. Now in Africa per se, on a private side, something which is between 100 150 beds works best. Anything beyond that might not be as profitable because it becomes a little too big for the geography under consideration, the kind of positioning that the hospital wants to have. So at 120, 130 bed capacity, the RPOB is quite similar to what it is in a comparable good private setup in India. But the EBITDA margins are higher. So out there, the benefit is that you have a better margin play. You have your overall profitability is likely to be better because the supply demand gap is significantly huge. So breaking even, getting the right occupancy in a shorter period is achievable if you plan everything properly and the management perspective is all clear on how they want to position their brand and manage the facility. So when it comes to average revenue, the reason why it plateaus at a particular level is that there are certain super specialties which will take more time to mature in Africa. Out there, all the hospital facilities which have a higher ARPOB, whether it's Apollo or whether it's Max, after a particular level in Africa, the ARPOB tends to plateau a little before it again seeks a second jump. Is that in comparison in India, you've got certain super specialties which are yet to mature in Africa. So when I talk about hospitals with a
Hmm.
higher ARPOB like Apollo or like Max, the reason that they are achieving that number is because a significant amount of their revenue is getting generated from specialties which are transplant medicine, which are cancer care. Now, these are high revenue generating faculties or specialties with which they are able to cater to in India, but which are yet to mature in the African context. So, if I look at Uganda, for example, as a country, not a single facility in private or the government setup is able to do transplants because the country as a whole does not have a, regulatory mechanism or an act which can govern organ transplant. So even if you have the infrastructure, you cannot actually proceed and do a kidney transplant or a plan or liver transplant out there. Same goes for cancer care. They have limitations when it comes to diagnostics. So there's not a single PET CT scan in the entire country. They've just got radiation therapy units only in the government sector. The private sector, it's not feasible because you will not be able to achieve the return on the investment that is to be made. So from that perspective, somewhere or the other, without these super specialties, the ARPOB will not be able to rise beyond a particular level. So once you achieve that particular level, then the growth is slower in nature with when it comes to the average revenue per bed. Definitely, there are multiple other modalities of growth where we will be expanding our network of secondary care centers. We will be putting a wide network of clinics, which will eventually lead to a much larger footfall, which will eventually lead to higher occupancy, across all the facilities, and will also likely lead to higher referrals from that unit into units in India for specialty treatments which are unavailable locally out there. So for UMC, there are multiple growth opportunities, but when it comes to a metric like ARPOB, there is likely to be a plateau phase which eventually comes in Africa, which in India is still not going to be the case because out here you have the ability to expand in newer specialties. Regulatory mechanisms are in place. So eventually, maybe in the second or third year after commissioning, UMC will be looking at transplant medicine. Some of the UMC facilities may look at radiation therapy and cancer care as a dedicated specialty. So the ARPOB will keep rising when it comes to India as compared to Africa, where it will witness the standard growth pattern. It may not be a big rise or a jump because of the lack of adding these facilities and specialties, at least in the near term.
Understood, sir. So the like as you rightly mentioned, the ARPOB is going to increase in India at a much faster pace. Sir, could you elaborate more on, the other segments of the business? We work in three other segments, like as you mentioned earlier. We work in
Right.
medical tourism. Yeah, so
So I'll begin
could
with
you throw
medical
some light?
tourism. Medical tourism was the first segment with which the company started, but because of a brand conflict within
Hmm.
UniHealth, in 2018 we actually moved out of medical tourism. What happened was that with our own investments in Africa, with our own hospitals coming up in Africa, we intended to do a lot of specialty work locally out there. And when we started discussing certain incentives with the government and the bureaucracy out there, we realized that they are viewing us as someone who intends to just do primary and secondary care work in their country, seek incentives, and eventually refer patients for tertiary care to India. So they were viewing us more as a medical tourism company and less as a serious healthcare player. And that is where we realized that there's a significant brand conflict and it may harm the overall brand positioning of Unihealth in these countries. That is when we decided to take a step back and position ourselves only as a healthcare player, as a hospital which wanted to develop infrastructure and services locally in that country and ensure that the outflow of patients from these countries can be reduced in the long term by developing infrastructure locally, because that is the natural curve. In 1960s, 70s, and 80s, people from India were traveling to US and UK. But eventually, our healthcare systems developed to an extent where today we have patients from these countries coming into India. And that is going to be true even for countries in Africa. If not today, maybe by tomorrow. So we wanted to be the first player out there who was able to make that change effectively, positioned there for the government to see. And that is where in 2018 we took a step back when it came to medical tourism. But with the decision to invest and set up our own facilities in India in 2024, we decided that we will be re-entering this space, because now we are not limiting ourselves only to the facilities that we own or operate in Africa, but the entire continent becomes open. With our own facilities coming out here, it becomes a big focal point for us to get patients even from geographies where we do not have a UMC, and also to cater to the patients at UMC in Africa, say in Uganda or in Tanzania, where they are unable to get a particular service at the local unit. So, from that perspective, we've re-entered medical tourism. The numbers from that perspective, in terms of revenue, profitability, will start coming in only from the coming financial year. So, we've re-entered. We've started seeing some traction in this. But the real numbers will start coming in from FY 26-27 onwards. Coming to the healthcare consultancy vertical, right now, like I mentioned, we are doing about 1,300 beds on a consolidated basis under that. But these are across multiple projects, and each project is in a different cycle. So again, to predict what kind of revenue this particular vertical will generate for the company on a year-to-year basis is extremely difficult, because our revenue generation is linked to the timeline of the project. So there may be projects where we are involved for a 5-year period, and the revenue generation the first 3 years might be small and the last 2 years might be significantly high, because it is going to be linked to the deliverables and the status of the project. So out here, what I can only say is that in the consultancy services vertical, the margins are significantly high because the deliverable is limited or the OPEX is related to the manpower. Now we've got a set team of project planners, of designers, of architects, interior planners, which is there, which can cater to one project, two project, or even 10 projects. Now this team, with an increasing number of projects, the addition is not in the same context. So if I'm adding on two more projects, the OPEX is not going to rise in proportion to the revenue increment. So my margins out here at the EBITDA level can range from 40% to maybe even 60-65%. So even though the revenue stream is significantly low when it comes to consultancy services, they operate at an extremely high EBITDA margin and eventually contribute significantly to the PAT margin. But
Pat,
I
yeah.
always put it across that in a long term, we view this as the both medical tourism and consultancy as the cream and the cherry on the cake. We do not put a number. Whatever comes in is an added advantage and a bonus for all the stakeholders. The last vertical that is there is the pharmaceutical export and distribution vertical, which we entered in 2020. it somehow, I would say that the first 2 years we were still battling COVID, so it was taking a slow curve. From 2022 onwards, the focus has been there. So we've added on a lot of companies whom we represent today. But under this vertical, each company requires registration at two levels. One is at the manufacturing level, and second is at the brand level. And this entire process in different countries in Africa can range between 12 to 24 months. Before we are able to complete this process, we cannot really trade in the local market or take part in government tenders, which form the bulk of the procurement in these countries. So, with special permission import licenses, we are able to cater to our captive consumption, which allows us to bring down our own cost of inventory and increase our margins. We also are able to supply to the private sector in certain scenarios where there is a supply demand gap for that particular product in that country. But yes, taking part in government tenders or the foundation backed tenders, USAID or UN backed tenders, that requires the product to be locally registered. That process is ongoing. Hopefully, in the next 6 to 12 months, a wide variety of those products will get registered. Some of those have been, some of those are in the pipeline. And once they are registered, then that particular segment is likely to open up significantly for UniHealth. So where today we are doing say 2 crore, 3 crore, 4 crore worth of business, this is likely to jump significantly, maybe 12 to 24 months down the line.
Okay, got it, sir. So we also I got a hold of the segments. So we also work with partnership with many institutions. So what is the strategic logic behind each partnership, whether it is related to access to patients, capital, or technology? Like how do you see each of these partnerships?
Right. So when we talk about partnerships, now there are multifold avenues when it comes to global collaborations that we have. One is where we are seeking to increase our accessibility to the patient base. So now whether we're whether it's collaborating with UN agencies with whom we are accredited today in Uganda, or whether it's partnering Myanmar Air, it's basically to ensure that we are able to provide our services to a larger footprint of patients. So the accessibility of our services to a larger network of patients, eventually allowing us to increase occupancy, increasing our revenue base, is one of the viewpoints. Second is collaborating with a large number of manufacturers in India. That is again for the export and distribution vertical, where we are collaborating so that we can represent them in select countries in Africa, export their products out there, and cater to the local requirement and demand of that particular segment of product range. So whether it's medical consumables, pharmaceuticals, cosmetology products, nutraceuticals, surgical goods, instrument tools, any of these, the collaboration is basically aimed at increasing the revenue by distributing these products to different segments, whether it's medical centers or hospitals or taking part in government contracts out there. So these are majorly the two avenues for which we look at collaborating when it comes to growing the business for UniHealth.
Okay, sir, understood, sir. So moving forward, sir, I'd like to understand more about we have opened a hospital in Navi Mumbai. So how do you expect it to contribute to the top line and in the margins in this year? And I understand like we have recently opened the hospital. So in the first year, the occupancy will be low, but how do you see the occupancy ramping up in 3, 4 year down the lines? And how do you see the revenue mix changing in the business?
Right. So in 2023, we had taken a decision that we would not be, that we would be expanding into India eventually, and that the idea would be that any unit under the fold, under the consolidated strength of UMC hospitals, should not contribute to more than one third of the consolidated revenue. If we look at our numbers today, significant contribution comes in from Uganda. So while Uganda has to continue to grow, our investments in other countries are likely to contribute significantly, such that the consolidated contribution from any one geography, specifically outside India, should not be more than one third. India as a whole can contribute to say 40, 45, 50% also, because India is the native country for UniHealth. So the geopolitical risk portfolio out here does not really have any credence. So out here, that is not really a risk factor when it comes to India. So with this idea, we decided that when we are aiming at 1,000 bed capacity, we would be looking at an equal mix, somewhere around 500 to 600 beds in India and somewhere around 400 to 500 beds in Africa put together. So from that point of view, we started making the investments. The Navi Mumbai facility has just been commissioned. So technically speaking, if I look at this particular financial year, I wouldn't put in a number because we would be operational for just about a quarter. And that too would be the initial period where our brand would be, getting positioned in the market. But Navi Mumbai is a boutique surgical setup. It's a 52-bedded facility where in the next financial year we will be aiming an occupancy level of anywhere between 60 to 70%. The target occupancy for us would be somewhere around 63, 65%. That is the aim. We do intend to, like all of our other facilities, operationally break even before the end of the first full year of operations. So that is the aim and the intent. The average revenue per occupied bed that we will be targeting out here would be in the range of 25 to 30,000 rupees per day. That is the initial target, and from there we'll be taking a growth curve going ahead. But before the end of this financial year, we also aim to commission our second facility, which is almost four times this size. That is a 200-bed facility in Nasik. So hopefully, by quarter three of next financial year, even that will start contributing significantly to the top line. So yes, by the end of financial year 2026-27, the contribution from around 250 beds in India would add up to the existing revenue base. We are also likely to expand our capacity in Africa. Like I mentioned, we are adding a 20-bedded secondary care center in Tanzania, which is again likely to be operational by the end of this financial year. And with the start of next financial year, we aim to add on 100 more beds in the tertiary care segment in Tanzania. So with all these additions, by the end of 2026-27 financial year, we will be crossing more than 500 commission beds, which will be contributing in some form or the other to the overall consolidated revenue for the company.
Got it, sir. So you mentioned about the timelines of the upcoming Capex, but what would be the, a ballpark figure for the requirement of the Capex? Like you have mentioned about the two projects, and the PPT
Right.
has also, about a cancer center also.
Right. So overall, in the next 3 years, to achieve this targeted bed capacity of 1,000 beds, we effectively are adding somewhere around 800 to 850 beds, and the capex requirement to add this, I believe, would be in the range of 175 to 225 crores, plus or minus, depending upon which stage the project is at when we are taking it over. What kind of renovation, refurbishment do we need? For example, in Navi Mumbai, when we took over the premises as a bare shell, but in Nasik, we are taking it at a much advanced stage. So the investment required in doing up the facility in Nasik is much lower than it was in Navi Mumbai. Definitely, Nasik, the overall investment is going to be higher because it's a 200-bed capacity. But based on this variation, the average investment that we are looking at is going to be in the range of 20 lakh to 25 lakh per bed that we are likely to make. So if I'm talking about, say, 800 beds to be added, then we are talking about roughly around 200 odd crores to be invested in the next 3 years by the company for achieving this targeted bed strength.
Understood, sir. So moving forward, like you have mentioned, the growth triggers for the business. Moving forward, can we expect the EBITDA margins to be in the similar ranges, or will it change with the bit of
Right.
revenue
So
mix?
over the next 3 years, the EBITDA margins on a consolidated level are likely to come down a little because we will be in a rapid growing phase. We'll be in rapid expansion mode.
Agreed.
So with the commissioning of new beds, the first 24 months, we will not be generating the same EBITDA that a mature business is. But what is going to happen is there's going to be a good mix or a good blend of contribution from a mature business with a growing EBITDA margin and contribution from, in terms of revenue from the new businesses. So somewhere or the other on the consolidated level, even though there is going to be a possible dip in the EBITDA margin, we are targeting at least a 30% EBITDA margin to be achieved all across compared to the 35-36% that we are achieving right now. But the
Sir,
total revenue
30%, yeah.
is going to be significantly higher. So in terms of
Yeah.
absolute number, the EBITDA will still continue to grow.
Yeah, sir. Understood. So the absolute EBITDA will grow with a much faster pace, and the
Yes.
margin dip will be for a few years as the Indian business will be maturing.
Right, right, right.
Also, sir, on the financial side, I saw like our trade receivables day are a bit higher. So how
Right.
how do we interpret it? Like, what is the reason for it and how one
Right.
should see it?
So first I'll go into the reason, and then I'll also put a small note on, or give you a brief about the mitigating factors that we're looking at. As we speak
Mhm.
right now, or even if I look at 25-26 as the financial year, ongoing financial year, the contribution to our top line will significantly be coming from Uganda, which is our flagship facility, which is our mature business. Now, one of the couple of key clients in Uganda are government entities, PSUs, or United Nations. Now, when it comes to the government entities, the very similar to the receivable timeline in India with government schemes out there. Also, we are the preferred hospital of choice for the Ministry of Defense for the entire military force of the country. Out there, the payment that we receive from them comes in a period or timeline of 9 to 12 months. So there are zero chances of bad debts because it's eventually the government which is paying you. There is barely any or zero rejection also out there because compared to other insurance companies out here, whatever invoicing that you raise based on the agreed terms, you are getting 100% of that as your payment eventually. But the timeline is significantly longer as compared to a typical cash paying patient or a typical insurance patient. Out here, the timeline is about 9 to 12 months. And this is the reason why our trade receivable days are significantly higher, even on a consolidated basis today. Going forward now, there are two ways we are looking at it in terms of the mitigating factor. One, as we move into the next financial year, there's going to be significant contribution coming in from facilities in India, maybe facilities in Tanzania also. So on a consolidated basis, the contribution of the Ugandan business will come down significantly, and the business in India is going to be at a much smaller trade receivable day period because the majority of it is going to be either cash paying patients or insurance patients where the receivable is going to be say within 45 days in India. So overall, on a consolidated basis, eventually in the next financial year, the trade receivable days are going to come down significantly. Simultaneously, what has happened in Africa or in Uganda, for that matter, is also that out there, the Ministry of Defense, which is the nodal agency which makes the payments for all the military personnel, has moved in from the standard practice of paying over 9 to 12 months with a few bolus payments that they make every year to a larger chunk to be paid every quarter. So we witnessed that with the start of their financial year this year, which was 1st of July. So between July and now, we've received a much larger payment compared to what we had received in the previous year. And we are looking at a scenario where the government out there wants to streamline the process and make larger payments on a quarterly basis compared to small payments with a bolus at the end of their financial year, which was the pattern earlier. So hopefully, if that continues, then the trade receivable days, even for Uganda as a standalone, will start coming down. And with that, the impact on a consolidated level for the next financial year will be significant.
Got it, sir. So I have understood how to interpret it, and there are a very little, or I would say no chance of going these trade receivables going bad debts. Yeah,
There's
got it, sir.
almost zero chance because of two reasons. One, when we entered this, we cross-checked with the bankers out there, with a lot of other partners, a lot of other companies and agencies which have been dealing with the government out there for a period of more than 15, 20 years. And each of them had the same feedback that though your payment may come at the end of 1 year from the date of invoice, it will come 100%. I mean, there's no rejection, and there is obviously no chance of bad debt because it is government backed. So we're talking about a sovereign body which is supposed to make a payment. So yes, the chances of this going bad debt is not there. Definitely, the receivable days have been high, but again, the good point is that the payment comes without any rejection, and the charges that we are able to charge are also a tad higher than the cash paying patient. Unlike in India, where you charge a little higher to the cash paying patient, and when it comes to TP and insurance, they negotiate a lower charge. Out there, it is the reverse because they also understand that eventually we are going to be banking on working capital limits with a financial institution, and there is a cost of finance that gets levied onto the company. So they do factor that in eventually in the pricing structure. So if I'm talking about a year, they are factoring in that cost of funding for the blocked capital for 1 year. So what I'm charging such clients or the corporates or the PSUs out there is higher than what I charge a normal cash paying patient. So eventually, from a margin perspective, also we are not really losing onto anything, even if you were to factor in the cost of finance.
Got it, sir. So for hedging the receivables, we use the borrowings from the local bodies from that market, or like do we use some other derivative instruments to hedge against the currency?
Right. No, so there are no real derivative instruments that we use because, again, African currencies to hedge, it's a tough task. No one
Hmm.
really comes forward to, and even if they do, the cost of hedging is significantly high. If you will look at the Ugandan currency, unlike Nigerian naira, Uganda has been fairly stable over the years. When we entered in 2016, it was 3,300 naira to 3,300 shillings to a dollar. As we speak today, it's somewhere between 3,500, 3,600. So it's not really depreciated significantly. We witnessed a much larger depreciation of the Indian rupee versus the dollar
Indian rupee.
during the same period. So the currency risk, though perceived in actual terms, we've not really had that when it comes to Uganda, where we have a presence, or it comes to Tanzania for that matter. So both these countries, we've not really witnessed that. So we do not hedge, these currencies or our receivables out there. Now, how do we fund these? Yes, local bankers do fund. Working capital limits are there. We had a debt in Uganda, which we had taken up both for purchase of the asset, which is the real estate, purchase of the equipment, and for working capital. But as of 30th September 2025, we have completely repaid that. So as we speak, from a banking perspective, our Ugandan unit today is debt free. So we have zero debt from any of the bankers. Now, whatever debt is there on the books in terms of Ugandan unit is actually from the shareholders. That is either Unihealth Hospitals has lent money to its joint venture company, or the other shareholders have lent money, which can be to an extent considered as quasi equity also, if you were to look at it, because it's basically supporting your own business entity eventually. From a banking perspective, we went debt free on 30th of September this year. One thing that, as a sector, healthcare is in a really exciting phase. UniHealth is positioned well when it comes to taking advantage of the opportunities that are unfolding. Luckily for us, compared to a lot of other peers in the same segment, and now I'm not even talking about the large players who have 5,000 beds and beyond. I'm talking about real peers who might be, having a bed capacity of ranging between 200 to say 1,000 beds right now. We have the advantage of having a strong foothold in a growing continent, that is in Africa. So that is something where no other player is there from an Indian perspective. There barely anyone from an international, perspective also. So this is an advantage that Unihealth today has, which is likely to unfold significantly in the coming 5 to 7 years. Like we are witnessing a wave of consolidation in the healthcare space in India today, where you've got the private equities funding a lot of mergers, acquisitions, and takeovers. Eventually, maybe in 5 to 10 years from now, the same wave of consolidation is likely to start happening in Africa, albeit in a select geographies which have the potential to grow significantly, but where UMC would have made its mark, where it might be the right partner for a lot of these impact funds, for a lot of these private equities to collaborate with for the next phase of expansion. So for us right now, Africa, provides us with a mature business, provides us with significant cash flows and profits, and in a period of 5 to 10 years, it is also likely to provide us with significant unlocking of value that the company might be looking at, and give us the required cash flow to expand rapidly in India at that point of time. So beyond this
Hmm.
1,000 bed, the next vision for Union would be definitely to aim a multiple of that. So whether it's 2,000 beds or 5,000 beds or beyond, at that exciting junction, we would be in an extremely good position to leverage our facilities in Africa, and strategically ensure that the growth in Africa and India takes place concurrently.
Definitely, sir. So best of luck to you and your company. And thanks for having this conversation with me. It was a great pleasure talking to you.
Thank you for having me with you for this discussion on Beat the Street. Thank you so much.
Thank you so much, sir.